We're going to take a little trip today and take a look at the current macro markets and some of the outlook for trends going forward, because I think there's a lot of things happening right now that are starting to kind of come to a head. Obviously, you've seen a lot of recent news both on CPI, the PPI data. We will see and continue to see some of the actions from the Fed start to resolve as well. So we're going to try to break it all down for you guys. And we have a special guest for you today. It's going to be a good one. My name is Paul Barron. Welcome back into Tech Path. Joining me today, of course, is Lyn Alden, who's been on our show many times. If you guys want to check out our website, just go to lynalden.com. You can get her investing newsletter, which I am part of that one. And I love your work. And of course, you've got a big book coming out as well. So thank you so much for stopping in on the show today.
Happy to. Yeah,
Yeah.
working on the book Broken Money has been like a big project over the past year, and it's also been very kind of educational for myself. So it's certainly been a fun project to be working on.
A lot within that book, too, for some of our viewers and listeners, if you're on the podcast side of thing. One thing I noticed is, first of all, was your guide through kind of the history of money, which I think a lot of people just overlook that, and that's something I think for today's macro economy and really understanding markets, that's a very good starter to kind of get your game on in terms of understanding what's actually happening here in the economy today. So excellent job there, Lyn. I want to start off the show here with a couple of things. We're going to get into CPI, and of course, this is Charlie Belillo talking about the overall. This, of course, CPI moved up to 3.7 in September from 3.67 in August. So third straight month we've had on year-over-year inflation rates. When you look at the current situation with just inflation as we've seen it, I think a lot of people anticipated some of these kinds of moves. What's your current thought on the direction of CPI and whether or not inflation is really going to have a major impact in, say, the next 2 quarters?
Well, so we've seen a rebound in energy prices to a certain degree. We've seen a rebound in housing prices. So when you look at the Case-Shiller index, for example, house prices were correcting. Now they've kind of stabilized. They've gone back up in aggregate. And overall, I think that's kind of the trend we're in now, in the sense that we've had a permanent boost in terms of how much money's in the system. Even as the Fed tries to draw down their balance sheet, there's still money coming in from the reverse repo facility.
Right.
So it's kind of balanced at the current time. I think, around the margins, I kind of see us settling here for a period of time because there's still downward pressure on a number of industries from these rate hikes. But part of what's fueling the inflation is the very large fiscal deficits. And what makes this kind of different from other cycles, at least up to a point, is that most of the money supply growth did not come from the banking sector. It did not come from credit creation. It came from large fiscal deficits. And we have very high public debt levels now. And so the challenge is, the whole process of raising rates is meant to slow down bank lending. It's meant to slow down kind of the main driver
Right.
of that money creation, which in the 70s worked because you had low public debt, you had very high demographic driven bank lending. But in this era and back in the 1940s, most of the money creation is from those fiscal deficits. And so the problem is when you raise rates, you actually increase deficits. We have 100%, over 100% debt to GDP. If you raise rates, that actually pours more money into the economy. And so I think they're kind of in this kind of like balancing act here where it's going to be hard to fully land the plane.
Yeah. Well, I think what you're referencing is your ex post here, past 4 decades, equilibrium of higher U.S. debt. And this was a good chart to kind of look at. Let me kind of zoom out on that a little bit. Federal debt versus public debt. And you can kind of see both kind of in line right here. When you look at a long-term outlook on this, because rates are going to stay high for quite some time, what does this look like on an overall chart, say in the next 6 to 12 months? Do you feel that we're going to continue to see this uptrend?
So the next 6 to 12 months, even if rates just stay where they are, so if they stop going higher but they just stay where they are, that interest expense is still going to go up a lot because there's still existing debt that keeps maturing at those higher rates.
Right.
And so even Treasury notes issued a year ago, for example, when they get refinanced at this current rate, they go up substantially. Any longer duration bond, like a 5 year, 10 year, a 30 year, anytime they mature and get reissued, it goes up. And so, if you run the numbers, we get up to something like 1.7 trillion on interest expense annually if you just hold rates where they are and have the full weighted average eventually catch up to that. Now, we wouldn't get that in the next couple quarters, but basically we continue to add tens or hundreds of billions of dollars in interest expense to the existing deficit at the current time. So I do think that we're going to continue to see very high bond issuance and continue to see extremely high and still rising interest expense, which is part of the deficit and is a source of money that is flowing out into the economy.
Yeah. Okay. Okay, that does not sound good. So, when you look at long term, and I think from a strategy standpoint, my question, I guess, would be the liquidity aspect is what is it going to look like with a lot of people still somewhat on the sidelines and now possibly looking at some exits starting to occur in traditional finance and maybe even in the bond market to a certain extent. We could end up seeing kind of a lull in terms of the market pressure here, at least in terms of, pent up demand or demand for some of these instruments out there. I was looking at Jordy Alexander. He had a thread that kind of went down into this. The Fed never looked as good control over the back end, especially in 30-year. He said not many investors willing to wait that long, obviously there. But his point goes on, Fed's starting to realize that there's simply no natural buyers for long end bonds, and they'll soon get very afraid. So, do you feel that is the current position right now when we look at the bond market?
I do. I'd be a little bit hesitant to say push the shorts here. I mean, we already had a very large down move in bonds. I've been a bond bear for years. I mean, the speed of this move even was kind of surprising to me, even as a bond bear. Um, and so the real rates are starting to get interesting. I can see, for example, why someone would want to go long tips here. You get a
Mm-hmm.
decent real yield on your position. The problem is not that at this point I think they're appropriately priced, but the challenge is there's just too much supply relative to demand. Basically, the types of buyers that are not so there's a couple main pools of buyers for treasuries. They could be the foreign sector, but they're not buying because the dollar index is strong, so they're in currency defense mode. They're not rapidly accumulating reserves. There's the Fed, but they're not buying. They're actually net selling by letting bonds mature off their balance sheet. There's banks, which were big buyers recently, but over the past year, that's reversed now. So banks are no longer buyers, and so that leaves only domestic non-bank entities. So insurance companies, asset managers, households. You and me, we're the kind of the only buyers left, and we're generally when we buy bonds, we don't buy them on leverage in the way that these like money creators can.
Mm-hmm.
And so there's really only so much that can be absorbed. And so it's more of a mechanical issue than investors assessing them and saying that they're inappropriately priced. And I think that's the challenge right now. And
Right.
so I do see ongoing problems that continue to occur. We could pause here. Bonds could get a little bit of a bid after such an oversold condition. But the risk reward is still relatively unattractive when you can hold T-bills, for example.
Yeah. Yeah.
And to the extent that I would get duration, I think tips are interesting, but the whole bond complex is it's still a mess.
Yeah, yeah. Okay, so I want to get your opinion on just kind of some of the direction, especially for Bitcoin primarily because of the macro pressures that we're facing really on a global and more economic front now, maybe more so than ever, especially with what's happening overseas. If you look at, I want to kind of go back to the Fed minutes and break down some things that came from this. Some people may not be aware of what all was done in the Fed meeting here recently, but the vote pause was unanimous. So that was one note. Another rate hike would be needed possibly for a future meeting, and that was a majority of the members believing that. Inflation risk deemed still to be skewed to the upside. They acknowledge that the larger anticipated tightening might occur as lags of policy and economic outlook are uncertain. Agree with that. Government shutdown may delay a release on economic data. I don't know if that's going to be a factor, but labor market still remains tight, easing financial conditions, obviously tightening up. Bank lending at the same time may finally be coming to a true tightening point, back to your point of public credit being so high, right now. And then further on, households now having to access credit, back to your point, to finance their spending. So this is a problem. All these kind of things we've talked about for gosh, almost a year, it feels like, in this very topic, and it feels like it finally has come to a head. When you look at this position right now with the Fed, higher for longer, now we see both inflation, consumer credit, real estate, all kind of very in a big limbo, I guess, to a certain extent. How do the risk markets play out in the near future? And I would say through at least Q1 of next year. And when I say risk, mainly Bitcoin. What are your thoughts?
So, I mean, any sort of multi-month prediction is challenging. There's all sorts of things that can happen, but in general, I view a lot of risk assets, including Bitcoin, as probably being kind of range bound during that time period. I don't see a lot of new liquidity coming to market, but I also don't see a high likelihood of major crashes. But I mean, if you get a liquidity problem in the bond market, that's where you could get a pretty severe drop in some of these risk
Right.
assets. When you look at Bitcoin price action historically, um, this won't tell you anything on a day-to-day basis, but on like a longer term basis, the major correlate it has is with global broad money in dollar denominated terms. So if you look at global M2, what is the total value of it denominated in dollars? And is that, the rate of change, right? So what does the year-over-year figure of that look like? Bitcoin tends to be highly correlated with that. So basically,
Mm.
it's a way of saying that Bitcoin is correlated with monetary inflation, which is different than and precedes CPI inflation. And so during periods of rise in liquidity, either because central banks around the world are printing, or banks are making a lot of credit, or the dollar's weakening, because that's the denominator for global M2 in dollar terms. When any of those major factors are kind of prevailing, Bitcoin is usually doing quite well. And when the majority of those factors are contracting, and global M2 is flat or down, that tends to put negative pressure on Bitcoin, or so at least that's the demand side. So the way I would
Yeah.
describe it is that over the course of this bear market, the supply side is tightened in the sense that fast money from the prior bull market has largely been washed out. A lot of coins have gravitated towards strong hands, people that are just dollar cost averaging in, hodlers. That's kind of a pattern we see in bear markets. Um, and so there's like basically a coiled spring there. There's not a lot of liquidity for buyers that want to come in. I mean, there's just not a lot of coins kind of ready to leave hands. But then the question becomes, what sparks the next wave of demand? And I
Right.
think it will likely be the next rise in global M2. And I don't really see that as likely in, say, the next 1 quarter, 2 quarters. Um, that doesn't mean you can't fluctuate. I mean, you could go anywhere but up over 30,000. You could go retest 20,000. I don't really have a firm view on that level of range, but I think until it would probably to see a bigger move, we'd have to see a pretty significant move in global M2.
All right. With that being said, I want to jump to a tweet here from Mike McGlone. Okay. He hits on that's similar to what you're talking about here. Bitcoin may lead the Great Reset by going down. And then he's saying that it's kind of a leading indicator. Bitcoin appears to be rolling over, which may be what's needed to signal a Fed Reserve pivot, sparking a bond market recovery is his theory. And then of course he's showing some recession fuel charts here on the S&P following Bitcoin and metals, of course, gold and silver. When you look at that and you look at that chart that he's talking about there, would that be in line with what you're saying? I'm trying to get my head around the two opinions there.
I mean, I think that would be on the more bearish side of what I see is
Okay.
likely. So it might differ the moderately from my case. I probably would be a little bit more constructive on price than he sounds like he is, at least in that tweet. But it's fully within the range of outcomes because again, I don't really see a lot of M2 growth happening over the next,
Right.
call it, 6 months. And so there, other than maybe a spot ETF or something, that might be the other
Sure.
catalyst. It's just a wild card that we don't know if that's going to happen in the next 6 months or not, right? So that's a whole nother decision point. But just looking at putting that aside, I think we're kind of in this kind of a stagnant range bound. At least that would be my assessment of the probabilities.
Lynn, do you really think though that a spot ETF would draw in, new investors into this space in the current market conditions? I mean, I would see maybe, the hodlers might say, okay, yeah, now we believe that this is a real asset. Let's put some more money in. But, those are people who are already convinced, have a conviction about these assets versus bringing new money and new liquidity into the market. Do you feel like that is going to open up or would it just be a short-term pump?
I think that there probably would at least be a short-term pump. Whether or not that would have staying power, I think that's a good question. I don't think you'd see necessarily massive inflows right away, but the market, market participants would have to then adjust what the next bull
Right.
market's going to look like if a spot ETF exists versus one that does not exist, right? So Bitcoin is not just buyers and sellers right now, it's also people looking out into the future and saying, what is the probability that this thing is going to be successful? Right. So, what does the regulatory clarity look like? Where are the sources of buyers going to come from? So, overall, that is a new variable on forward expectations of price, which is for most participants would be pretty constructive. So, I think that could give you a either a quick bump or maybe a more durable kind of smaller higher level to kind of stagnate around for a while. But I think where that becomes relevant, particularly, is if we have a spot Bitcoin ETF and then we get that global M2
Hmm.
rise, because then the spot ETF's there to absorb any liquidity that wants to come into it that doesn't want to go on chain, right? So there's plenty of capital in brokerages, in 401ks, in other types of environments that would probably make use of a vehicle like that. They've had kind of very limited vehicles so far. So I think it's a catalyst, and that can certainly move around price either to the upside or downside based on what news we get. But I think the more durable rise is likely to happen with the aforementioned global broad money supply.
Yeah. Before we go over into kind of the market trend section of the interview, I want to jump over to this is kind of a screenshot from a video we did with you back in May. And you hit on several of these markers here. Obviously, what's happening within your portfolio at the time. You had a good position there on Adobe, which I think was your AI play, and quite a bit here on MicroStrategy. And then, of course, you had some access there on Grayscale. Would you go the route of possibly moving GBTC into something like a MicroStrategy, as a long-term play here, if you had
I think
GPT exposure?
I think they both have different risk profiles, right? So with GBTC, you have to worry about the having a persistent discount to NAV, the possibility that it's not going to be converted to an ETF anytime soon. Just that kind of ongoing challenge. Whereas MicroStrategy, you have to assess an operating company and then you have to assess their financial leverage. So I
Hmm.
consider them somewhat different vehicles. MicroStrategy technically has positive carry. I mean, it's a profitable business, but you do have to factor in the financial risk there. So I don't really have a strong opinion between the two. I like to diversify a little bit. I do think the cleaner vehicle overall would just be a spot Bitcoin ETF. That would clear
Right.
up a lot of problems with having Bitcoin in a portfolio because GBTC has been a flawed product. The futures ETFs are flawed products, and MicroStrategy I think is a good product or a good company, but it's just a very different risk profile than just owning actual Bitcoin. So I would just put that in kind of a separate camp. The same thing with the miners. You're taking on
Yeah.
operational leverage, which gives a very different risk profile.
Yeah, for sure. I want to give you kudos. We did a video with you. I want to play a clip of this piece right here. Listen in.
Maybe the play that's not fully crowded yet is to ask what becomes way more accessible now that this technology exists. Say Adobe Photoshop is a fairly advanced piece of software. In general, the creator economy, art, storytelling, programming, engineering, that becomes a bigger pie that more people can do, and that the tools that serve them have now a bigger market.
So, congrats, Lynn. You hit that one dead on the head, and that was back in May. It was actually May 30th. This was the movement right here on chart that I'm showing. 42% up right now if you're playing Adobe. But the bigger move here was the AI positioning that Adobe put into the market. You hit it exactly on the head, and that was the release that we've seen in a lot of different Adobe tools that have really started to advance up the creator market. Now, with that being the case, and you look at what's happening in the creator market and with things like Unity, obviously we saw John Riccatello step down because of this most recent, train wreck that occurred over at Unity. With that being the case, meaning the fact that AI has been represented into a lot of these new software products that are really large software suites that have been out for a long time. I mean, is there a lot more upside in those kinds of plays right now? If you look at Meta, you look at obviously what is happening with Adobe. There's going to be many others, including Microsoft, et cetera, that will all play into this kind of this landscape. Where do you think this is going in the next couple of years?
So I think after this sharp rise in price, the risk reward is not as attractive as when I originally, presented Adobe as a
Hmm.
as an AI play.
Yep.
Back then we already had a huge rise in Nvidia. I didn't love the risk reward after such a big euphoric spike, whereas Adobe had not really moved yet, and I felt that that was understated. And so I'm glad to see that the market kind of, I think, caught on to their ongoing success there. But now the valuation's not as compelling as it was earlier this year. I still think it's a I think it probably over a 5-year period. I think it's still likely to as well. I think the company is going to fundamentally do well. But with bond yields as high as they are, providing a higher discount rate to consider when we evaluate these kind of higher growth, higher value companies. I'm more neutral on Adobe at this current time. I wouldn't be
Okay.
surprised to see it stagnate for a while, grind up more slowly, maybe have a correction. But yeah, lower conviction than I was earlier this year.
Good info. All right, I want to jump to SocialFi. So this is something that we've seen a lot of very small projects kind of come to a head, some challenges within SocialFi overall. But if you look at the charts, the cumulative numbers have been accelerating here. So not bad in terms of a new area that I would say are going to exist. Obviously, we know what X is doing. I know you're big into Nostr. You've got other decentralized, platforms out there like Mastodon, et cetera, that play into this. When you look at that and you think about the future of SocialFi, do you think there's something there in terms of platforms like those starting to really become something big?
I think so, and I also think it's going to depend on basically when someone decides to get off of a centralized platform and onto a decentralized platform, or at least to diversify their usage across some of these more decentralized
Hmm.
platforms. Usually there has to be a reason for it. Um, and it could be that they don't like the moderation of that centralized platform. They don't like the type, maybe they were blocked, maybe they, have some sort of issue like that. We face that issue less now in the US, but there are other countries where they have trouble accessing social media, centralized social media. It can be very censored. And so tools like Nostr, I think, are very helpful on that. I would be wary of ones that have kind of inbuilt incentives, because those can prop up the numbers in the front, but they risk kind of being Ponzi-like, right? So you kind of
Right.
get this like big upswell, but then people realize they don't actually like the product. They were just there because there's like a way to make money out of it. The
Hmm.
reason I find Nostr more interesting, um, is it has less explosive growth and it has less kind of inbuilt mechanics. It's just an enjoyable ecosystem for those that like it. It doesn't have like this is it's more like incentive based or Ponzi like aspect to it. It's just this kind of organic thing that's there for people that need it. That's generally the way I view this going. I'd be somewhat wary about um, the sustainability of some of these other ones.
Interesting that you say it that way. All right, so I want to jump to a clip. This is from Mark Zuckerberg in a recent interview about this, and I want to get your opinion on this. I'll ask you a question after this clip.
The more that there's interoperability between different services and the more content can flow, the better all the services can be. We can also start to support more interop, which I think is going to
with
be
other
interesting too.
services like Meta that Meta doesn't own, other messaging
Yeah,
apps.
well, I mean, the plan was always to start with the interop that between our services, but then to get to that. But yeah, we're starting to experiment with that too. I just don't think that people like feeling locked into a system.
Yeah.
All right, so this is a very odd statement, at least in my opinion. I've watched, the history of Facebook since 2007, a walled garden to be the easiest explanation of it, and it hasn't really changed much. But now what Zuckerberg is saying is something completely different. Talking about opening up, going into interoperability across platforms, federated media really is what we're talking about here. First of all, do you think he's being truthful there? And if he did that, if someone like a Meta truly did that, what do you think would happen to SocialFi as a whole?
So I think it'd be good if he did. I mean, the two main challenges there. One is incentive based. Companies
Hmm.
generally don't want people to leak off of their platform. They'd rather have them siloed. And number two is that if a bunch of companies want to communicate with each other, they have to agree on what protocols they're going to use. And everybody wants a different protocol. How do you come to some sort of like agreement? I mean, that's not an impossible thing. It's a longer term, higher friction type of process. Um, Part of why I like Nostr is that it already kind of has that model in the sense that Nostr itself is an open source protocol, kind of like email protocols, right? So when we think of email, you're not locked. It's not like only Gmail people can send emails to other Gmail people. You can have different numbers of webmail providers. You can run your own email server, and they're all interoperable because they're all using the same standardized open source protocols. And Nostr is like that in the sense that the underlying thing itself is open source, and people can build clients for it that communicate with each other. So you can go on Damus, you can go on Primal. These are different client types. There's other ones as well. And you can talk to people that use the other client types because kind of like email, you're using the base Nostr open source protocol.
Right.
That's also, I mean, that's the key argument for what Bitcoin and Lightning are with money, in the sense that they can tie ecosystems together in an open source way. Instead of having, different countries and different silos and different financial silos, they could be connected. And I think it's, for example, it's not a coincidence that Jack Dorsey likes both Bitcoin and Nostr. He's on Nostr quite a bit these days, and as well as like Cash App, for example, is integrated with the Lightning Network, and so Cash App, even though they have their own ecosystem and all sorts of advantages for people that want to use that ecosystem, they have an opening to the outside world through that Bitcoin Lightning channel, so they can integrate with any company that does that open source protocol. And so I think if social is going to go that direction, open source underlying protocols tend to be the fastest way, because you don't have to. It's like, for example, if Cash App wants to integrate with any other company, they don't have to do each one manually. Just any other company that joins the Bitcoin Lightning Network now has a connection to Cash App, for example.
Right.
And any new client that hops on Nostr can automatically work with any of the existing clients. So if we start to see social, either Nostr-like or some of these, maybe Twitter and Meta getting together and deciding on an open source protocol, if those things start to be built, then yeah, I think you could see more interoperability. But you have to get through egos, you have to get through business
Yeah.
models, you have to get through what is actually the most efficient way to do this, so that once you have that in place, it can build very quickly because it's distributed. Anyone can just start attaching to that protocol.
Yeah, and I think that's the challenge right now is maybe there has been kind of a come to a horizon here from Zuckerberg's position, and I know he's into a lot more Zen, getting into jujitsu and all that. Maybe he's coming into some realization. Maybe there's a different route here to take. So it'll be interesting to watch. I want to go to our last topic here, and that is talking about tokenized assets in general, traditional assets. Now, we had Van Eck on here on the show, I think it was yesterday, with Matthew Siegel, which was really kind of their digital asset lead. I want you to listen to a clip from him. Listen in.
These tokenized real world assets are going nowhere for the meantime. They're just adding additional cost and complexity. The yields that you can get on an on-chain T-bill are less than what you can get in an actual T-bill. It's just not a very interesting product right now, neither for the issuer nor for the buyer. Bitcoin has to 10x in order for these to become interesting, right?
All right, so Matthew Siegel said that tokenized treasuries, I'm looking here at just the chart. You can kind of see what the activity is right now. There's still a significant amount in terms of tokenized treasuries out there. Overall, when you look at this potential for blockchain in general, what is your opinion on tokenized treasuries? We saw what's happening with obviously JP Morgan and the BlackRock assets and some of the strategies that are starting to play out. Where do you think this is going?
So I have a constructive view on them. For a long time, my view has been that I've been bullish on Bitcoin and stablecoins. And stablecoins are kind of the original tokenized real world asset. You're tokenizing the dollar. Now that there's positive yields out there, there's also demand for things like treasuries, like this asset. The way I would phrase it is that I've been very critical on most of the crypto space, but there is a platform here, an idea here of making real world assets more accessible, in the sense that, I mean, as an example, I know a physician in Egypt who holds physical cash dollars, for lack of knowing what else he wants to save it. I mean, the local currency is growing in supply at 20% a year, and so that's one of the things he turns to. There's a lot of capital around the world that'd be happy to own some T-bills, and the access point is challenging. So if you're inside the US, something like a tokenized T-bill is not particularly attractive. You can just there's plenty of ways to hold T-bills. If you're in Nigeria, a tokenized T-bill could be quite interesting if you're able to access it. And so we live in this world. There's like 160 different currencies. There's financial borders and firewalls around themselves. They try to keep capital in. And what this technology is doing, whether Bitcoin, whether stable coins, things like that, is they're making these borders more porous. It's kind of saying, instead of just being stuck in your own ecosystem, you can go out and buy a global asset that's better than what is available in your own country. It basically, makes savings and investing more accessible globally. So
Right.
I do think that this idea has legs in an international context. Now, of course, the challenge is it's both technology itself, and then there's regulations, because these are potentially disruptive. And so, I think it's also a matter of awareness. So people have to overall take time to trust the systems, realize that this is something that can solve a problem for them. But yeah, I do think that more globally liquid and accessible assets does make sense. I think I view Bitcoin as kind of the foundational innovation here, because that one is the truly decentralized asset. Um, but the main kind of draw from these tokenized assets is that although they're fully centralized, the appeal for a lot of these people is that the central hub is not in their own country. They're accessing something that is outside of their own inflating controlled bubble, and that's attractive to them. It's kind of like
Right.
offshore bank accounts for the middle class, right? That's essentially what this type of technology is currently enabling, and I think that is a real world use case.
Well, and there is enough demand out there. We've already seen that, obviously, even with a very small, but very small crypto market, and how that's been utilized in cross-border payments, the way to move money in dire situations. But that starts to create those early bleeding edge use cases. What you're talking about is the potential next layer, which would be drawing in a lot more, non-traditional investors that would typically be in something like a Bitcoin or Ethereum, et cetera, and going in and saying, okay, I can understand how to move into this because it makes sense to my strategy in terms of my investment. So I would agree with you. Well, it's good to hear that you would say that, because I do think there is a big future for tokenized assets. Would agree with you. I think international is probably going to lead the way. All right, Lyn, thank you so much for jumping in today. It's always fun chatting with you. If you guys want to check out her book, here is her website. Just go over to lynalden.com. You can get Broken Money right there, and there's a link right there over to Amazon and all that good stuff. To grab the book, I would recommend a read if you want to learn about how money is going to change in maybe a very short time with everything that's been going on. But Lyn, thank you so much for stopping in. We appreciate it.
Thank you for having me.
You bet. All right, so you guys are maybe listening on the podcast side of things right now. You found us on Spotify or Apple iTunes. One of the things you can do is jump over here to the YouTube channel and subscribe. Just hit that little bell as well if you want to catch some live streams. We're trying to pick up our live streams, even though our recorded videos, I know you guys like those as well. But hopefully the live streams will start coming more frequently as we kind of get into this, hopefully a little bit of a market correction as things go. If you're not part of our Diamond Circle, make sure and jump in on that as well. It's very easy and it's free. We'll leave a link down below. If you want to catch me out there on X, it's @Paul Barron. We'll catch you next time right here on TechPath.